Hello, all. Thank you for coming. I am your temporary MC. The MC is on break, so I'm playing moderator and MC. I enjoy being on stage, so it works out well for everyone. I'm Mike Dudas, the CEO and founder of a company called The Block. We are about a year old, and we provide research, analysis, news, and insight about the digital asset ecosystem, which is ever expanding. I'm delighted to be here in France, as are all of the panelists. We were speaking backstage, super excited. I was in Asia 2 weeks ago. The energy there was palpable, and the energy here is incredible upstairs, and really excited to be speaking with you folks and with the panelists. So our topic today is institutional investment in the crypto ecosystem, and we're very, very fortunate to have a group of folks across the entire investment stack. So folks who are making direct investments, fund of funds, folks at companies, and then folks providing infrastructure to people who, to firms that invest in the ecosystem, and then myself, who actually covers these folks who are investing. So I think it's going to be a really, really interesting conversation. And without further ado, please welcome our panelists. Gentlemen, let's just start, and we'll start on this end. Would love each one of you to do a brief introduction of you, your company, and your involvement with institutional investment in crypto.
All right, so I'm Mark Yusko from Morgan Creek Capital Management in Chapel Hill, North Carolina. We are a registered investment advisor that primarily focuses on the traditional world, but we have migrated in the past couple of years toward blockchain. Just raised our first dedicated venture capital fund, Blockchain Opportunity Fund, getting ready to launch our second fund here in the second or third quarter.
Hi, thanks. My name is Charlie. I am the CEO of Woorton. We are a market-making firm in the crypto space, actually backed by 2 French institutionals. And we provide liquidity on exchanges and off exchanges to a wide range of professional clients. And we will dig a bit later about that.
Hi, my name is David Fauchier. I'm the CIO at a firm called Cambrial Capital. We are an investment advisor based in London. We manage a fund-of-funds strategy.
My name is Andrew Robinson. I lead the institutional business in EMEA for Coinbase, which includes our exchange, our OTC desks, our qualified custodian, and our broader prime brokerage suite of products.
Excellent. We're going to start really high level, and again, we'll start with you, Mark. What is the state of institutional investment in crypto today? I know that's a very broad question.
Yeah, we tried to think of a word backstage, and I think it's a couple words. It's fear and loathing. So institutions are still afraid of the asset class, and part of it, I think, is this question of, is it an asset class? I'll argue that it's really not an asset class, it's an access class, and that ultimately, we're going to have crypto stocks, crypto bonds, cryptocurrencies, crypto commodities, and those digital assets will replace all the traditional analog assets. But today, it's still viewed as something new, something separate. And so most institutions are afraid, wouldn't touch it with a 10-foot pole, and some have tiptoed in.
Charlie?
Well, we have the opportunity to have Mark that can testify about, I guess, the US market. What's interesting in the French and European market is that we have everything we need for institutional to step in. I mean, trading infrastructure built by a company like Coinbase, by Woorton. We have a regulatory framework that is getting there. But I think the institutionals still need some education to be convinced that we have an investment opportunity. And I think it's gonna come in the coming years, but we still have some work on the way.
David?
So Mark can speak much better to the sort of to the American landscape. I think on the European side, we gave a panel. We put together, I think, a very high-quality panel, really high-quality speakers from very reputable firms, including kind of Cambridge Associates, for the biggest private equity and venture conference in Europe a few months ago called Super Return. And we were there, and it was standing room only, and we were waiting to come on stage, and it was packed, and people were standing at the back. And the panel ends, and we get announced, and somebody mentions the word blockchain as they're introducing us. And like 75% of the room just got up and walked out. And the remainder were on their phones, writing emails. There was a guy who was asleep in the front row, which was fun. There's sort of an inability or lack of willingness to even engage with the premise of the question. I think that's what we're seeing in Europe at the moment. So we'll see.
Andrew?
I think taking a step back, I think it depends on how you define institution, right? Because I think that we have seen institutional participation from crypto-first institutions, be it VCs or kind of long-only asset managers that have entered the space. I think that when we think of some of the traditional institutional investors, the long-only real money, the pension funds, they still are not here. And part of that reason, as the other panelists alluded to, there's infrastructure reasons, there's lack of clarity, there's several different kind of factors that are preventing them from entering the space, given their fiduciary responsibility in a real way, at least right now. But I think that a lot of people are definitely kind of doing the work and having the conversations despite what we may see.
Excellent. So let's start from the institutional side. What types of institutions are investing? And then I want to follow up. The next question will be, what types of strategies are they investing in? So why don't we start with the types of institutions that are investing in cryptocurrency, and I'll, whoever wants to start.
So I guess I'll pick it back up. Yeah, so again, a lot of the traditional venture capitalists are already in this space. There's kind of the crypto-first asset manager that has evolved in the last 2 to 3 years that are active in this space. A lot of market makers and prop funds. Some global macro hedge funds that are using kind of GP capital as well, I would say are kind of the institutions that are most active in the dominant way right now today.
Yeah, just to follow up with what Andrew just said, we have to remind people that cryptocurrencies, compared to other traditional assets, has been first invested by retail investors. That created an opportunity for market makers, for algorithmic traders, in terms of volatility, to just design algorithmic strategies to take value from this volatility. And that's why the first player we have been seeing coming in are, as Andrew said, are the market makers, like the algo traders. And then come with funds like Mark, people coming from more an institutional background and traditional finance.
Yeah, Mark.
Yeah, I think you have to, as Andrew said, you have to separate the types of institutional investors. If we think of institutional investors as big pools of capital that are professional asset managers, a lot of them are here and have been here in different ways. Some in small, toe dip, some in bigger, kind of not quite all in. But there are institutional quality firms all over the world, particularly in the U.S., high frequency traders and big hedge funds that are definitely active in the crypto world. Now, I have to separate also between crypto itself and the infrastructure. So you have to choose as an investor, am I going to invest in the liquid crypto market as just directly? Am I going to own Bitcoin? Am I going to own an interest in an LP in a fund, in a hedge fund structure? Or am I going to go into the infrastructure and private? That's where we've started to focus, and we are fortunate. We got 6 institutions to invest in our first fund. Healthcare institution, endowment, a foundation, an insurance company. But the big one was 2 public pension funds. And the first public pension funds we're aware of that have kind of crossed the chasm. But it's not crypto specific, it's infrastructure, equity in businesses that are building out the crypto.
Yeah, that was my next question. So how do you see that split evolving? Maybe from a funds perspective, it would be interesting to know what the different strategies that you're seeing are, and the different types of whether it's companies and or tokens themselves.
So maybe as a bit of background, what a fund of funds does is it's basically a fund that picks other funds. And so a fund of funds' job is basically to go around and talk to all of the different types of funds and figure out which are the more attractive strategies on a risk and return basis. I think our our view, I think that the landscape has evolved a lot over the past 4 years that I've been looking at these funds, and most actively in the past year and a half. But where we are today is there's a lot of VC money that wants to somehow index the space, because if crypto gets big, then they're going to fall behind anyone else who did index the space. And so in Europe, they're looking at their LP agreements, and because pretty much every VC fund in Europe took public money, they have very restricted kind of clauses in the LP agreement around being able to invest in liquid stuff. And then on the US side, it's sort of a similar thing, that you have these hygienic investments that you can make in crypto or blockchain or whatever you want to call it, and Coinbase would be one of them. There's nothing wrong with it, but you're investing sort of in picks and shovels. I think we step back and look at this, and there is a lot of money chasing these hygienic opportunities. I think Telegram was one. Telegram was basically a version 2 of the Kick IPO with Kin. These basically get bid up to ridiculous levels. And so there's very high valuations in all of the hygienic crypto deals, and nobody is looking at and touching, relatively, the sort of protocol layer investments.
What makes something, what are some qualities that would make something hygienic? Is it brand? Is it people?
You're investing in equity. It's a real business with real cash flows. I mean, exchanges have been a wonderful thing to invest in for the past 6 years. I would suggest that it's something you should have done in 2013, 14, 15, which Pantera was doing, and they were the only ones, and they got ridiculously low valuations on some of the biggest exchanges today, and they killed it. Today, everybody sort of wants to do an exchange or a custody provider or something like this. And so where we see the sort of relative value is in the places that are uncrowded, and that fundamentally a lot of these kind of picks and shovel bets, while they may be investable, are highly correlated to the underlying tokens themselves. So, you know, Bitcoin goes up, volumes go up, therefore exchanges make more money, and the same on the way down. And so it's not necessarily decorrelated, you're just paying maybe more for the same type of exposure.
Got it. Anyone else have thoughts? So one question I would have, playing off the last thing that you said, is it a question that comes up, this correlation between, if Bitcoin goes up, seemingly all 2,000 tokens that you see on CoinMarketCap go up. If they go down, they go down. How do you answer this question of just all the assets being correlated, and how you specifically, you maybe as an investor, can generate alpha for folks?
Yeah, the biggest thing for an institution to think about is, one, are you going to get return from making that investment? Two, is it going to have a portfolio benefit in terms of low correlation with other assets? Markowitz won the Nobel Prize for saying, hey, if I have bonds, that's a really risky portfolio. If all I had is bonds, it's the riskiest portfolio I could own. If I add stocks to it, my risk goes down. If I add real estate and hedge funds, the risk goes down. The problem is that's not the perception. So when I brought up hedge funds to the first time in 1993 to my board at Notre Dame, they said, no, we can't invest there. That's where all the bad people are. And then when I got to North Carolina in 1998, I said, all right, we're going to invest in hedge funds. And like, no, we banned hedge funds 2 years ago. I said, fine, we'll have no hedge funds. We'll have long, short equity, opportunistic equity, absolute return, enhanced fixed income. And the president says, that's just nomenclature, right? I said, yeah. He says, good, as long as we're clear. And we put 60% in hedge funds. And from 2000 to 2002, we didn't lose any money, because not only is it not the bad people, it's the good people. In every business that we're aware of, the best person charges the most and finds a way to be on the same side of the table. So the problem for institutions today is they've been looking for that diversifying asset. And the problem is stocks and bonds, 40% correlation. Hedge funds, 50, 60% correlation, and actually rising as people get less hedged. The interesting thing about crypto assets is they are the first time in my career, and I got white hair, so it means I've been around long enough to say this, it's the first time in my career where a diversifying asset actually fulfills the need. It's 0.15 correlated. If you put Bitcoin in a portfolio, you add 1% Bitcoin to a 60-40 portfolio, your return goes up 25%, your volatility doesn't change, your Sharpe goes up. You add 3%, and this is during bull markets and bear markets over a 5-year period. The first 5 years of Bitcoin, they don't really count. There's too much illiquidity. But the last 5 years actually reasonably count. To your point on the altcoins, that's the challenge, is people conflate the term cryptocurrencies, which there are about a dozen. Then there are utility tokens, which people call cryptocurrency, but they're not cryptocurrency. They have no store of value or use case for medium of exchange. They're simply pre-seed stage investments, 90% of which are going to fail and go to zero. So and then they have no liquidity. So they're not a viable alternative for institutions. And then you've got security tokens, which are coming. The promise is they keep coming, and they will eventually get here. And when they do come, it's going to change the world in terms of institutional investment. But for right now, if you take an asset like a Bitcoin, you add it to a portfolio, you get diversification benefits, and you get alpha.
A broad question, bit of a curveball. We didn't prepare for this one, and maybe Andrew, you could start. Should the builders in this room care, or why should they, or should they care about institutional investment in this space? As a builder myself, it feels like there's no shortage of general purpose capital. Record venture capital funds generally. Should we be thinking and focusing on this, or is this really just an investor concern and a token price concern? Should the builders be thinking about this?
I mean, undeniably yes, right? Because I think that to Mark's earlier point that he made, in terms of a lot of what we've seen early days, and also Charlie said this as well, was just retail driven, right? So in terms of should you care about the institutional capital coming, that's what's going to really help foster this innovation. That's what's going to help drive this ecosystem to the next level. We've only seen a portion of that capital allocated to the space. And it's something that we were saying downstairs, at least from institutional investors, you can only ignore alpha for so long. Once that alpha is very much there in your face, they're going to want to be a part of the ecosystem or participate in what's being built by a lot of the people that are here in this room.
And that means more builders, I guess, would be then the follow-on to that.
I'm going to take the other side of this just for fun. My hope for prices for the next year is that they sort of don't move, go up a bit, go down a bit, whatever. I was speaking to the founder of one of the oldest crypto exchanges, and he was very happy that we were in a bear market. This was last year, because he said, my engineers don't work when we're in a bull market. Because why would you work when you have $1 million worth of Bitcoin and a 100K salary? We sort of need these periods without the frenzy in a sort of Goldilocks zone, which I think is where we're at right now. There is enough VC capital that's been locked in already that if you're a really high quality project, you can raise the money. I think there's sort of a good balance right now between the amount of money available and the amount of high quality people building high quality projects. We sort of seem to be at a good equilibrium, and we've only seen progress in crypto increase over 2018 as prices have collapsed. And that's a good indicator of that. The ecosystem has never been healthier. It's never been moving faster. There have never been more people, in terms of quality people, moving in. I hope that we don't get another massive bull run, because it's just going to end up exactly the same as the last one did, because we're still in this kind of technology maturation phase. Nobody is using this stuff. And so a year from now, we'll have prices 10x where they are again, and people will look and say, is this stuff actually valuable for anything? And then it'll crash. And so we need, I hope, a sort of period of moderation in which people are working hard, building stuff, and stuff does get funded. And there is enough capital locked up, I think, for that to happen.
Excellent. Mark, question for you. So we were talking backstage, Harvard just wrote a big check to Blockstack in their recent, or will, I guess, if the token offering is approved. Yale put money into Paradigm. So we've got two of the premier endowments in the world who are putting money into cryptocurrency, and that seems like it's the tip of the iceberg. Can you talk a little bit about the major institutional asset classes? So in the context of, do they have different expectations? Do they mean different things? Or is endowment money and pension money, ultimately, when it gets to the end recipient, the same thing?
No, look, it's really interesting if you look at data and you look at 20 years, the last 20 years, if you just bought and held stocks, you made 8%. If you bought and held bonds, you made 6.5%. The average pension fund made a little under 7%. The problem is the average individual made 3.5%, right? All you had to do is buy stocks and hold them, made 8%. buy and hold bonds, you made 6.5. The problem is the individuals don't do that. They buy what they wish they would have bought up high, they write it down, and then they sell what they're about to need down low. The endowments, the average endowment made 9.5% over that same period, so about 9%, about 150 basis points better than the pension funds. And think about that. Over 20 years, if you compound at 9 instead of 7.5, you actually end up with $6 billion from 1 instead of 5. So you make an extra $1 billion. The top endowments, Yale, Princeton, Stanford, Harvard, Notre Dame, et cetera, made 12. Now that's 300 basis points more than the average endowment, 450 basis points more than the average pension fund. That's worth a lot. That doubles the value that you would have had if you would have made 7.5 instead of 12. Now, how did they do that? By overweighting innovation as an asset class. And they've always done this. They've always had a heavier weight in venture capital. They've had a heavier weight in innovation and things that drive wealth creation. So when I was at Notre Dame, we invested in this firm called Sequoia. We gave them $5 million. They put 10% in this little company called Google, which at the time was the number 21 search engine. We took out $200 million. There should be a quad at Notre Dame called the Google Quad. So how does that happen? Well, it's innovation. And so what Yale is doing, what Harvard's doing, what other smart institutions are doing is they're saying all the innovation is in this new technology. And if you think about technological evolution, 1954 was the mainframe, 68 was the microchip, 82 was the personal computer, 96 was the internet, 2010 was the mobile net, and 2024 is the trust net. My term, use it liberally. So the trust net is coming and it's going to be bigger than the internet, bigger than the mobile net, and this is the greatest wealth creation opportunity we will ever see in our lifetimes. And if you're not getting involved now, you're missing out. But I don't feel strongly about that.
I'm excited. Wow. Tokenize the world. The virus is spreading, as your partner would say.
Yeah.
We're all, yeah, I'm a big Pomp fan and friend as well. So the interesting thing about what Harvard did is investing in a particular project. Do folks on stage expect more of that to happen? And again, is that typical or atypical? That struck me as new. You know, Harvard's endowment investing in a specific company. How does something like that happen?
What happens? It happens through co-investment, right? So they have investments in the private equity firms that were the backers early. They make co-investments. It's the same way we invested directly in Coinbase because we knew the people who invested in early, and so we came in through a co-investment with people we know. So co-investing is a great discipline, and it's what, again, the endowments have done for many years, and even some pension funds and some big, individuals with institutional-like capital. And I think it is going to happen more, but it requires technological understanding. It requires partnership with people who, and that's one of the reasons that a fund of funds is so attractive today, because it's impossible for a new person into the space to really get a sense of who's good and which projects are worth backing. But if you partner with really good firms that then give you insight and knowledge and relationships, you can capitalize on that.
Excellent.
I would say, in addition to that, for an endowment, the way that they allocate capital is different from some of the institutional investors. So the direct investment becomes a bit easier to digest, to be able to articulate as well. But I think that, one thing that we haven't talked about that will also get institutions involved in this space, not just the kind of boring passive index funds, but some exchange-listed products and some structured products that will have, a QSIP or trade on that exchange, because then, as a capital allocator, you can go say to your LPs, I'm not holding Bitcoin, I'm not holding this protocol, this project, but I'm holding something that very much feels and looks like a traditional security, like any equities or bonds that I also hold in my portfolio.
And is this, thank you for bringing that up, and question, do you have in mind, the long-awaited ETF there, or are you thinking more along the lines of these security tokens and other tokenized assets that we've been waiting for, and there's seemed to be a start with Securitize and Harbor and others, but frankly, I think Morgan Creek is one of the few that's actually got had one of those offerings get out the door. Is that the type of thing that you're talking about?
I think that unfortunately the ETF is probably still a bit further down the road. To Mark's point of view, very excited about security tokens. I don't think it's 2019. I think 2019 is just kind of, people are saying that because ICOs are gone and we need something to get excited about so we can get up every day. But I think that it's more about kind of actually Europe has led the way here. And we talked, Charlie mentioned kind of about, Europe setting precedent with a lot of the ETPs that are being launched in Switzerland and some of the other exchanges. I think that we'll see a lot more of that coming in 2019 or early 2020 before we kind of see the STO market take off, just because there's not that many exchanges where these STOs can actually kind of trade in real volume yet.
Absolutely. Yeah, so ETPs are exciting, disclosure, I'm an investor, and Immune, which offered on... Me too. Oh, you are? Excellent. All right, well, I'm a much smaller one, I promise. So, Charlie, I'd love to... we were talking backstage, I was at Economy 2 weeks ago, as I mentioned to the folks here, and there are IEOs happening, and we're still talking about ICOs in Korea and across all of Pan-Asia. It was a really interesting thing. We're talking now here about regulation, conservatism. Charlie, can you talk to me a little bit about what you're seeing on the ground in Paris and around Europe?
Sure. First of all, I would like to come back to something that we never mentioned in this kind of panel, but it's a secondary market. For once, we have an illiquid asset that we can trade right after the fundraising and with easily with the technologies that allow us to do it. We have seen in the market making space, in the secondary market, crypto secondary market, crazy behavior about market makers that were doing wash trading, player doing crazy thing in the field, fake volumes that were reported by some exchanges. We have seen the project doing their own market making. That is crazy. We have seen many things that are absolutely nonsense in terms of regulation. You're talking about regulation. If we talk about regulation and we just focus on this behavior, it's crazy.
I wish we had more reporters to cover it. It is crazy.
Exactly. And if we want, because it is the subject right now, if we want institutional to step in, this behavior has to stop, and we have to see strong player coming in with good attitude, but also with regulation. And in France, in Europe, I think regulators took the subject very seriously, trying to drive some regulation for the secondary market, for the crypto secondary market. But once again, we have the regulation, we have the framework, we need now the players, the real market makers that will do it, the real institutional investors that just step in. We need that.
Excellent. So 2 more questions. We have about 8 minutes. Where's each of you and or your companies doubling down in investing in 2019 and beyond? And you each sit in a very different seat, so I think it'll be interesting to the audience. Andrew, maybe start.
I wouldn't necessarily say, I'm not sure if we're doubling down in this space, but...
Where are you focusing?
From my seat, we're focusing very much on 2 things. One, international expansion to, our mission is to create an open financial system for the world. And what that means is getting this technology into the hands of as many people as we can in as many regions as we legally can possible. And to David's point, to make it actually to get out of this investment phase into the utility phase. So 1 for us is international expansion, and 2 is institutional involvement in terms of continuing to build that infrastructure. From a ventures point of view, one of the big things that we're focusing on outside of just the underlying protocols is kind of beefing up our custody offering to be more interesting than just cold storage. So facilitating things like staking, the ability to participate in governance.
What's the implication there, by the way?
The implication there is that, I forget the numbers, but I think that when you look at something like Maker and the amount of people who actually kind of participate in the governance, it's less than 5%. The implication is that it's really twofold. 1, you can earn rewards. I don't think we can legally call it interest because then you get taxed on it. So you can earn rewards for the assets you hold. So it's the ability to earn that yield and participate. And 2, similar to owning equity, it gives you the ability to basically have a proxy or a voice for the future of that network as it relates to governance.
Excellent. David?
we've been spending a lot of time looking at what you'd call market neutral funds. What these guys, the sort of very trivial example here is an arbitrage fund. You know, they buy Bitcoin high and they buy it low and they sell it high. You know, within the same second across 2 exchanges. All of these sorts of and there's many more examples that sort of sit into the same pocket. We've been looking at that and at generalized mining as well. These guys are doing this work, and market makers and all of these kind of like high frequency traders and prop shops, all these names you hear, they're doing it because there's alpha to be made and they can make money. But the very interesting sort of secondary effect of that is that it makes markets efficient. And if you look today at you know, a blockchain product where you can go and lend out on Compound or buy a debt product on Dharma, or you think about Augur, and using prediction markets there to sort of do the equivalent of a derivative, or you go and you lock up some ETH on Maker. All of these different projects actually rely on these types of kind of arbitrage funds to actually support prices and make prices efficient. I think what we're seeing is a new asset class emerge. And that's generally a generational opportunity. This does not happen often. When it does, there's a lot of people that don't understand it. And at the moment, all of these markets are, if we think of DeFi, extremely fragmented. And what we need in order for it to actually work, for it to be usable, is for people to basically equalize prices across all of that. And so it's sort of this interesting opportunity from a making money perspective, which is sort of very selfish, but at the same time, you sort of need it in order for the markets to work. And so I think it sort of has a sort of social good attached to that as well. And so I think that's a very interesting thing that we're really seeing ramp up over this year.
Great. Charlie?
For us, I mean, the challenge for the coming months and the coming year is to get closer to all the issuers that issued crypto assets, raising millions of money, millions of dollars, millions of euros, and getting closer to them, take some inventory of the token and handle the liquidity of an illiquid asset and provide it through an infrastructure that fits institutional investors' requirement for these investors to actually step in. And it has been done for Bitcoin, it has been done for Ethereum, it hasn't been done for all the projects we have been talking about and all the new coming one. This one, the liquidity needs to be enhanced. It's right now, like you have a very low float and a very low volume on those assets. And our challenge is really to get closer to them, deploy our algorithm to enhance the liquidity and provide it through a state-of-the-art infrastructure for institutional investors to have access to it. And that would be our challenge for the coming months.
Yeah, so I mean, yes, doubling down. So I think for us, Morgan Creek Capital Management created Morgan Creek Digital Assets. We hired a team. We're doubling down on the space. We raised a small fund, $40 million. We've invested in 21 companies. We're 70% of that is directly in businesses, 15%, 1.5 is in other funds, and then 15% can be directly in crypto. So we had not invested in any crypto up until 6 weeks ago. We started to buy Bitcoin around $4,000. So we think that is a place we're doubling up. We're really doubling on businesses that are being built around crypto infrastructure. A great example is Figure. Amazing business being built out in San Francisco to do lending on the blockchain. And then we're getting ready to double down on fundraising in that we're going out to raise our second fund. We're going to go after 250 to 300 million because the demand has exploded. Once people said, oh, you guys are here, you're doing this. Okay, so fund 2 is easier to raise than fund 1, so we're pretty excited about all the opportunities we're seeing. And the thing that I've been most impressed, and it's a lot of the people around the room and other rooms that I've been in, is the deal flow, the inbound deal flow from really outstanding entrepreneurs and builders. I've only seen this once in my career. The talent migration is very similar to the early 90s in the internet when people were leaving amazing jobs, amazing opportunities, and coming into this thing that their parents said. It's like Bill, or the famous story about Steve Ballmer when his mom said, honey, why would you go to work for that company? No one would ever want a computer in their house.
Love it. Love it. So, by the way, the headline tomorrow is going to be that you guys invested in Bitcoin at $4,000. And we all could have assumed by Pomp's recent tweets, but you've confirmed it. No, but that's really exciting and a big shot in the arm. and show of support. So we have a minute left. This is lightning round. One big institutional prediction for 2020 or by 2020. Rapid fire.
Regulation.
Meaning,
Oh, sorry. There was one word. Some regulatory clarity from. We had good progress out of Switzerland, but from the U.S., the UK, some of the larger countries to get the institutional investors comfortable with the space.
love it. Praying.
The BIS, Bank of International Settlement, tries to squash this by introducing all sorts of risk management and controls requirements on banks, which means that banks can't open accounts for crypto companies. I think that ultimately won't work, but I think we will see some pushback.
Who steps in, by the way, quickly, if BIS pushes back? Anybody
Steps into provider?
Yeah.
You'll just go with the really, really dodgy banks that you were banking with 2 years ago.
Okay, great. We're red, so quick.
My word would be time. I was at a dinner with Mark yesterday. He told me, Bill Gates said, we overestimate what we can do in 2 years and we underestimate what we can do in 10 years. If we're talking about institutional investment, I think we have to wait and we have to give them some time to step in.
Excellent. You guys will keep doing great work.
I mean, the biggest thing is looking back, whether it's 2 years from now or 10 years from now, our big thing is #GetOffZero. As a fiduciary, right now, institutions are saying, as a fiduciary, I can't invest in this space. When we look back 2 years from now, as a fiduciary, you cannot not invest in this. I mean, you must invest in crypto assets. And those who don't will be looked at askew and askance, and they will be the bad fiduciaries looking back in time. So get off zero is the mantra.
Love it. I'm going to start saying that quite a bit, and I'm sure you will. Thank you, panelists. Thank you, audience.